Hey traders, this is Christian from Tribeca Trade Group with your weekend video on levels to watch for next week and events to watch for next week and how to position, how I'm positioning my portfolio going into next week. So what are the key events for next week? We've got a bunch. I'll start with the third round of the debate. That's next week. We also have a lot of U.S. economics that are coming out, a couple different data points here that I think are going to be noteworthy. You got industrial production, you have the CPI data, you have housing data that comes out this week. And then outside of the U.S., China has their third quarter GDP estimates. That is midweek, that's coming out. If you remember last week, there was some volatility around China's trade numbers, which missed big. So it'll be really interesting to see what that third quarter GDP number is. We also have an ECB meeting, and then we've also got more Fed speakers that will be out next week as well. Always want to be cognizant of those as they could provide a little bit of volatility to the market. And then last but not least is, which I actually view as most important, is we get a big chunk of the earnings reports that are coming out next week, and will really set the tone, I think, for whether this market has another leg to go or whether or not we're breaking down. So speaking of breaking down and kind of looking at the major indices, let's dig into the S&P chart. I always like to go out to the weekly chart first and look at the bigger picture and then kind of drill down on smaller time frames. So what are we seeing here on the weekly S&P futures chart? Well, the major level to watch is 2117. That's the top of value. We've gone all the way through this yearly value area. We've been above it for a couple months now, but we look like we're getting very close to breaking that support. Now we can of course touch it and hang in there, but we're really close to this 2117 level. If we break it, not so good for the markets, and I will be looking more at shorts. So let me go ahead and drill into what we're seeing on the daily chart. And another level to watch, besides that 2117 support, we're right at 2127. That's support for the month of October. We're also right along this this upward trend line. This has been intact for about a year now. So we're right at the bottom of this trend line, and it's crucial for the market that we hang in here. So those are the couple things that I'm watching on the S&P chart. Of course, we had this triangle pattern for about a month and a half. We broke it, but we have this another level of support. This is where we need to really hold. The next thing that I want to look at is small caps. Small caps always interest me because sometimes they provide clues on the overall direction. There's sometimes a little bit of a leading index to watch. And just like I did with large caps, I want to look at the weekly chart first. And this is pretty revealing here. We went all the way through the value area. This is again the yearly value area. We've gone all the way through it. But we're not able to break above it. We try to do it a couple of times or a couple different weeks here, and what I'm watching here is 123.21. So we're below it. We're firmly above it right now. IWM is 120.43. We need to get back above to be in an upward trend. We need to be back above 123.22. 123.21 for us to be in a bullish trend. And so I'll wait. There's no reason right now to kind of guess to see if it's going to get back above there. We'll find out in the coming weeks if that can resume the trend. On the daily chart, a little bit more ominous here. We're breaking the support of the monthly value area. That's 121.08. And you could kind of see we're breaking down here. So it's not going to take us much to get back into the value area, but for the time being, we're below it, and that's bearish. So that's small caps. NASDAQ, I like to look at the Qs as well, but the Qs really are not telling us too much. They're right in the middle of the value area, so a little bit stronger than large caps and small caps, but pretty much neutral. So that's kind of where I am. Where my stance is right now is I'm neutral the market. If we break that support in the S&P, I'll become bearish. Further evidence why I'm neutral this market and not bullish is looking at the S&P sectors. Sometimes those reveal some clues there, and I did this exercise about a week ago, and you could see that there's only a couple sectors, tech, energy, and financials, that were above the 50-day moving average. You got a bunch of sectors below the 200-day. Luckily, those are small weights in the S&P, so they're really not affecting the S&P that much. However, not so good when you don't see a lot of sectors, above the 100-day and above the 50-day moving average. So what kind of changed from last week to this week? Well, you had three, you only have two now. So despite strong earnings from JP Morgan and Citigroup, financials actually dipped back below the 50-day moving average. But they could easily get right back above. They're just a hair under the 50-day moving average. We've got a lot more bank earnings this week that could get the financials back above that 50-day moving average. You got Goldman, you got Morgan, you got Bank of America, all reporting in the beginning of the week. So that'll be very interesting to watch. Other sectors that moved from the previous week, industrials, they were above the 100-day moving average. Not so much anymore. They're now below and into this yellow group below the 100-day moving average, along with consumer discretionary, materials, and telecom. Another mover that was in the yellow, now in the red, is healthcare. That broke below the 200-day moving average. Healthcare was one of the worst performing groups last week. So, the main summary that I would say is deterioration that's taking place here in the sectors. And, of course, if we were outside of earnings season, I would say not looking so good for the market. But, a couple strong earnings reports can kind of revive this market a little bit. So that's something that I'm watching. Finally, one another note to make here is this remains a stock picker's market. The JCJ implied correlations within the S&P 500 are indicating that there's still low correlation among stocks in the S&P 500. So, how do you interpret that? What does that mean? You can be a bit different than hedge funds. You could be different than investment managers who often have a mandate that they're either going to be a macro fund, they're going to be a long short fund, they're going to be a long only fund. As this flips around into a stock picker's market, or more of a index type market where everything's moving the same, you can change your portfolio easily. You could adapt much quicker than a larger fund can be. So right now we're in a stock picker's market. You can be long names that are exhibiting strength, and you could be short some of those weaker names. So, until this changes, until the JCJ, moves up, so where correlations, stocks are moving all together, I think you have an opportunity to be long and short names here, and make money on both sides. One other point before I leave this page is, being that it is earnings season, a lot of the buyback plans for companies go into quiet periods where they can't buy back shares during that time. So you don't have quite of a floor as you normally do with the market, as companies are not buying back every day anymore. So you could see a little bit of a downside pressure, being that those buyback plans are off around this time of year. I always profile in the weekend newsletter ETF fund flows. I try to look for clues about the market here. What is this telling us? The last 2 weeks, no inflows, no outflows either into the overall market, into overall equity ETFs. It's essentially been flat the last 2 weeks. However, there are some rotations that are going on. We're seeing a continued rotation out of REITs. Just a lot of money going out of REITs. This is for the last week, $700 million. If you put the last 2 weeks in perspective, it's $2 billion that have come out of REITs. So I talked about those defensive groups, or those bond proxies, seeing a little bit of pressure as interest rates go higher. That's something to continue to watch. Also, money still flowing into energy and technology. I thought this was a little bit interesting, even though the bigger market cap weighted ETFs that have, for example, Apple and Microsoft, a big chunk of their ETFs, they're still seeing inflows. However, what I thought was interesting was semis, for the first week in a long time, actually a little bit of outflows there. So something to keep an eye on there. And then in international ETFs, these emerging markets keep on chugging along. It's now, I believe, 15 straight weeks of emerging market inflows. So there was another $1.3 billion that were added into emerging market ETFs. And this is despite the dollar strength as well. So normally once the dollar gets stronger, emerging market equities don't do so well. But it seems like investment managers are still putting money to work there. So further in our weekend newsletter, I highlighted REITs just as because they do look weak here. I actually started another short in this. I've been short the last couple weeks in and out of REITs. Last week they actually outperformed a little bit and stabilized, but I think they've got a next leg to go lower, especially if that TLT continues to move lower and rates go higher. Which brings me to the next chart that I want to look at is the bonds here, and they now broke below the 200-day moving average. This is a must-watch in my opinion, because interest rates affect so much because of those bond proxies, which could see money being moved out of if this continues to break below the 200-day moving average. So keep an eye on this level here. And then finally, the U.S. dollar. U.S. dollar has seen a real nice move in the last couple weeks. Keep an eye on this here. I do think it's a bit overbought. The RSI right now is, I believe, is 72 right now in the RSI, and also on our Raptor indicator, it's indicating the highest rating right now, which is a plus 12. So maybe a little bit overbought, and I think they need to do a little bit of a consolidation before, if they're going to move higher here. All right, we also have stocks to watch, which I'm not going to go into. You have to be a paid subscriber to see that, but we've got a bunch of stocks to watch for next week. So thank you very much for watching this week's newsletter. Again, my stance right now on the market until we see some guidance for some companies or technical levels breached or moved back into positive areas is I have a larger position in cash than I normally do to kind of to watch and wait to see how things play out a bit. So you could subscribe to our newsletter at TribecaTradeGroup.com. You could be a part of our online or our real-time trading room. Or if you can't be in the room full-time and you want to get ideas from newsletters, we do have a newsletter program. It's under the Swing Trade program as well. You also get real-time alerts with that. So that's it for the video, and thanks for watching the video, and have a great week.